Okay, shifting gears. Here are the performance numbers for the two portfolios I manage, Tarpon and Gecko, for year five. I put year five in quotes there. Neither portfolio was actually launched on January 1st. Tarpon started at the end of November, the last third of November. Gecko started at the end of January 2009. In the packets that were provided at the annual meeting, there are calendar year numbers too. If you're listening to this on the blog and want those numbers, by all means, please give me a shout. These numbers you're seeing here are after all fees. They're also as verified by an independent third-party firm, and it's that firm's reports that I'm happy to email or provide to anybody who asks. The point really here is that we had very good absolute numbers in both portfolios last year, and Tarpon did incrementally better on a relative basis than its benchmark, although Gecko did lag a small amount compared to its benchmark. Not that I was necessarily concerned about it, but that is how it shook out. That said, it is an odd thing to kind of stand in front of people and tell you that I was mildly disappointed with those kinds of numbers last year. All of those gains really came in the first half of last year, until really a bit more recently, until early 2014. We were, for the back half of last year, just kind of in a slow sideways grind. I think since we met last year at the annual meeting in 2013, we had similar numbers for Tarpon and Gecko, but our outperformance compared to the indices was significantly higher. So we sort of treaded water in both Tarpon and Gecko for the back half of last year, while frankly the market just kept rising. If I had to sort of self-critique our performance for last year, then in retrospect, I'd say two things probably jump out. The first is that we had a higher than average cash balance in the portfolios for most of last summer and fall, and this is specifically in Tarpon now. That was due really to selling out of some positions when their stock prices reached close to what I believe each business was probably worth. My mistake in retrospect was probably letting that cash sit too long for, in the end, no real good reason. I was really probably slow to redeploy that cash due to the dog that didn't end up biting. And more specifically, I'll try to geek out a little bit here with my statistics hat on. I was concerned to some extent about another political squabble over the debt ceiling that loomed last September. And you may remember at the annual meeting last year, I talked a little bit about it, had a few slides with regards to how polarized the country was. Again, it wasn't something, it wasn't actively shorting the market, excuse me, or otherwise getting really defensive in the portfolio. I was probably just greedy, point blank, and was kind of hoping we would see some panic in the markets around that September time frame, just to get an even lower prices on things. So if I were to sort of put on my statistician's hat, my null hypothesis, if you will, last year was that squabbling politicians were going to incite financial panic in a showdown over the debt ceiling, yet again. And I probably made what is called a type 1 error. I thought the market would essentially sell off reasonably hard during that debt ceiling debate, and frankly it did not. I was probably, again in retrospect, overly influenced in coming to that conclusion or making that mistake due to the real mistake I actually made back in August of 2011. And as you recall, that was when our esteemed political leaders on both sides now did push the debt ceiling issue too far, and the credit rating of the U.S. was painfully downgraded. So, lesson learned. Being in cash in and of itself didn't hurt our overall performance last year, but it did impact our outperformance. The self-inflicted wound I think we did suffer last year when it came to Tarpon specifically was with regards to one of the companies I stood up at this meeting last year and told everybody in some detail about, and that specifically was JCPenney. You may remember I felt pretty good about our odds of doing real well in JCP. We went over, at least at a superficial level, the filings underscoring the real estate value the company owned. I talked at least some length about how I'd paid 30 people to converge on JCPenney stores all around the country to take pictures on the same weekend and just had them report back on how the rollout of one of their new brands was going. And to fast forward quite a bit, we ended up selling out of every share we owned in JCPenney in late September last year. That was really for three reasons. The first is that I confess I felt a little bit misled by management. The day before the company announced it was going to raise about $1 billion by selling more stock, their CEO let it be known on CNBC that they did not have a need to sell more stock. So I guess, just started to have a few doubts about the credibility of management at that point in particular. To be clear, I suppose I should have known better, and ultimately that's on me. That's not on management. But the way that they announced the raise also highlighted that one of my key assumptions was frankly flawed. Specifically, I'd assumed that JCP was going to use a more equivalent mix, an equal mix of both debt and equity to raise funds. I also assumed that it would be months later, and I also assumed that the total amount of funds that they would raise would be less than they ended up actually doing. So the size of the raise, which was about 84 million shares, was about 3x my own estimates, and that would lead to about 44% dilution, and that was really the third reason we sold out of JCP. I don't really want to highlight this to sort of self-flagellate and beat myself up about it. I think there is a learning point in here, ostensibly for both me and for you guys, for investors. And really with regards to dilution. Dilution is an important topic to understand as an investor. If a company is growing rapidly and needs to raise more money to continue growing, it will often sell shares to new investors. If you are an existing investor, while that company is growing and they happen to sell shares, then in general, you can probably be okay with it, all things being equal, because although the slice of the pie that you own is smaller, the pie itself will get larger, so on balance you'll make out fine. So it's kind of a strained metaphor analogy, but hopefully you follow me there. The point is this though, if a company is not growing rapidly and they issue new shares, then the size of the pie is going to stay the same and your slice will just get a whole lot smaller. And in JCPenney's case, it got about 44% smaller. So to sort of summarize all that, in that case, we'd really effectively been assuming a lot of the business turnaround risk, but then the reward was going to start to get distributed to others, full stop. So, the equation changed. In the end, we took a loss on JCP and moved on. Fortunately, again, not to, beat myself up too much over it, just did want to point out that mistake and talk a little bit about it. The point, though, is even by that 32% number, we did have a number of other companies that did real well for us last year and more than made up for the JCPenney issue. Bank of America did real well for us. AIG did real well. So, we had a good year. I'm probably emphasizing the negative a little too much, but I do think there's a legitimate point in there, both just general accountability and to underscore, the negative implications of dilution in general. About the only thing I can promise you regarding whatever mistakes I make in the future is that they will all be new. Here is a snapshot of Tarpon's performance from inception through basically the Friday before Memorial Day weekend. Again, these slides are the same as I presented at the annual meeting, which was over Memorial Day weekend. So from inception through May 23rd, I believe it was, 2014, that's what a snapshot of Tarpon would look like. On an annualized return basis, Tarpon has done 22.7% a year over those 5 years since inception. The S&P 500 index, as you probably have guessed, has also done quite well over the same period of time. S&P did about 19.6. Again, the 22.7% per year number for Tarpon is an after fee number, and you can tell it's been anything but straight up. 2011 was particularly wild, but we stuck to our guns and bounced back and came back even stronger. So there is probably a lesson or two in there. This is Tarpon's performance in year 6, which is basically from November 20th of 2013 through, again, this was Friday, May 23rd before the annual meeting. You can see some volatility this year as well. That just kind of comes with the territory with running a concentrated portfolio like Tarpon is. I also mentioned, I should point out that since the annual meeting, and as I pointed out in those performance numbers that I read at the beginning of this voiceover, Tarpon is now up on Tarpon year basis 14.6%. So that 7.75% number was only 6 weeks ago. We have had one of our positions in Tarpon in the intervening month and a half that has more than doubled. That certainly does good things to your performance, and I'll probably talk more about that position publicly at some point, but not to get too distracted now. The point is, yeah, we are having a decent year, outperforming, and going to try hard to help that continue for us. Here's a snapshot of just big picture, kind of your options as an investor. And again, it kind of speaks, I suppose, to some of that back and forth you saw in the actual performance chart for Tarpon. That bottom 3% level, that is a very stable, secure 3% a year. It's possible to achieve for investors by investing in something like treasuries, at least, putting aside any concerns about inflation, interest rates, all that. The point is, there's different ways to approach investing. If you are looking to earn more on an annual basis than treasuries, and you're willing to put up with a little bit of waviness, if you will, in your returns from year to year, then it's conceivable to do 8% a year over time in something like an index fund. Where we are, though, and I think everybody grasps this, but it's important to point out, is up a little bit further. That 23% number is actually the annualized return for Tarpon again. So that's a sort of a real number. We've done 23% a year for 5 years now. It's been anything but straight up, and that is just a straight mathematical average. The point, though, is this. There is no reward without risk. Wall Street and this industry in general really tries to make the case or tries to convince you that volatility, that waviness is risk. I really couldn't disagree more strongly. Probably a whole other conversation. I just don't think true risk is volatility. It's not a number. True risk is really screwing something up in your analysis that leads to a fatal error when investing, meaning you lose a lot of money. All of that is, again, a long-winded way to say that there's no such thing as a smooth, steady, stable 23% a year. It's just going to bounce around a lot on you. I'm okay with that. I trust that you guys are too. But just kind of a reminder of how investing works and value investing in particular over time. Here's a snapshot, similarly to how we just talked about Tarpon, of Gecko. Gecko, again, is the equity income portfolio. Right now, actually, yields a little bit less than 6%. But it is a portfolio I don't really talk too much about. Just numbers-wise, most everybody here, the vast majority of people here, are invested in Tarpon. That's really where all my own family's money is, so I tend to focus on that. Gecko, though, has been a phenomenal portfolio for income investors. Part of the reason, or probably the main reason, that Gecko has significantly less ups and downs than Tarpon is really related to interest rates in more of the indirect way. Because interest rates have been so low, what you've seen really since early 2009 when Gecko launched was this quest for yield by all sorts of folks, and by that I mean they're really buying and to some extent probably chasing too much uh, high or secure dividend stocks like we have in Gecko, in addition to those MLPs. So Gecko has done quite well on a capital appreciation basis, really at this point, even outperforming Tarpon. A lot of that is again related to where interest rates are and that sort of constant quest for yield. But hey, we'll take it for sure. Gecko, believe it or not, on an annualized basis over the 5 years that it's been in existence, has done 27.5% a year, and that's compared to about a 19.5% return in the S&P 500. Again, a fairly unusual period of time that we've been in where what should be sort of the boring old staid equity income portfolio has really done phenomenally well, which speaks to a lot of things, including that quest for income, that quest for yield by a lot of folks out there. And here is Gecko, its year 6 through, again, last Friday, which was the Friday, May 23rd, lagging the S&P 500 benchmark a little bit. It has since, as I think I mentioned also in the beginning of this voiceover, Gecko on a year-to-date basis has now sort of gone the other way and is surpassing the benchmark, and that's again just in the last 6 weeks since the annual meeting too. So that those numbers are trending in the right direction. So is the outperformance, and happy with that to date, and hope those of you who are Gecko investors in there are too. This is just sort of one of those big picture slides. Could talk at length about really any aspect of either Tarpon or Gecko or the process for finding the securities that go in there. I don't want to give it short shrift. It seems to be really where I spend most of my time, or try to spend most of my time, in kind of keeping up with our companies, looking for new companies, and just trying to stay focused. Really, the process that I use today is still very much the same as that I've used on day one, and this is specifically when I'm evaluating a company for possible inclusion in either Tarpon or Gecko. It's really, this is a big picture now, an issue of trying to lay out the investment case like I do in the investment letters that I write to you all. Really, there's 4 major parts and one sort of subpart that I've always kind of viewed our companies through. And it's really a matter of answering these questions. Is it a good business? Why is it cheap? Is it cheap for temporary reasons? That 4th line, what are the implied expectations? That was something that really started out as kind of a subcategory of the next line down, what's it worth? But it's become more important, I think, to me personally as time has gone on. So I kind of break it out separately, at least here. All of which is well and good. We can talk about it forever. The point I want to make in this slide, though, is probably the biggest change, and it's not necessarily material, but it may speak to more of the times we're in, is with regards to the text in the orange there. I think that question of why haven't the algos discovered this amazing opportunity that I seem to have found, I think as time has gone on, that seems to have become more of an important question for me personally to answer as I'm managing your money in these portfolios. It is so difficult these days to compete as an investor, simply because there's so many really good, really sharp people out there, and more to the point, a lot of those very sharp people also are very good at programming algorithms to find things that are cheap even faster than guys like me who just sort of sit alone and look for these things all day. What I think I'm finding, and this isn't really a conscious decision as much as it is just sort of a in the rear view sort of summary of some observations. I think the positions and the companies that we have typically done the best in, i.e. that have gone up the most for us, they tend to be ones that are probably otherwise undiscoverable by the algorithms. And by that I mean, if there is an easy way to make the case that something is cheap just based on its existing financials, reading the annual report, taking a look at all of the financial reports you can get your hands on and really doing that sort of back of the envelope math to prove that A, this is a great company, B, it's cheap. Then these days, because computerized trading is so dominant, and because 70-75% of that trading on a daily basis is literally computers and algorithms essentially trading back and forth with each other, I think it's becoming more important to find or to have investment theses that the algorithms can't pick up. And by that I mean things that are either represent sort of options that aren't necessarily even addressed in or easily viewable in the company's financials. Sometimes those are external events, just catalysts that, frankly, are just hard to program. It's hard to build an algorithm that can accurately capture when, for instance, a consent order might be lifted on a bank that we're invested in. But the reality is, when that consent order is lifted, that's a huge catalyst. That's a big deal. It's just hard to program it. So probably getting a little too much in the weeds, but the process that I use today is by and large the same as I've always used, with that kind of one exception. And for whatever it's worth, I thought it might be interesting just to surface it. But the idea of finding great companies that are demonstrably cheap is still core to what I'm doing. It's just they're harder and harder to find, really independent of the market valuation thing. It's just more related, I think, to a lot of those opportunities sort of being sniffed out well before any human can get to them, because of all the algorithms out there. Excuse me.